Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Justin Carbonneau and Jack Forehand are principals at Validea Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validea Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validea Capital.
Hey guys, this is Justin. In this episode of Excess Returns, Jack and I sit down with Gary Antonacci, principal at Portfolio Management Consultants, founder of the Optimal Momentum Investing website and the Dual Momentum blog, and author of the book, Dual Momentum Investing, an innovative strategy for higher returns with lower risk. We talk with Gary about momentum investing and specifically his focus on the concept of dual momentum investing, which combines relative momentum and absolute momentum together in one systematic approach. We talk with Gary about how dual momentum can be used on other asset classes and what some of his momentum research shows when applied to an asset like Bitcoin. As always, thank you for listening. Please enjoy this discussion with Gary Antonacci. Gary, thank you very much for joining us today.
My pleasure.
Today, we're going to talk about dual momentum investing, the concept that you developed and explained in your book, Dual Momentum Investing, an innovative strategy for higher returns and lower risk. I think it's going to make for an interesting conversation, just given some of the things we're seeing in the markets right now, with the recent declines and the changes in leadership we're seeing among stocks so far this year. But before we get into that, I wanted to talk sort of get into some of the other things maybe you've done outside of investing, which we found very interesting as we were doing some research on you for this interview. And one of the things that you had done is you were at one point blending, I guess, comedy and magic together, and doing performances of that. So I wanted to start, maybe I thought it'd be fun just to hear about, what you were doing when you were pursuing that interest, and maybe what your favorite trick was, if you want to share that with us.
All right. Well, during the 1980s, I was running some hedge funds, and I had this idea of using modern portfolio theory to combine together the best commodity traders I could find. So I work with people like Paul Tudor Jones, Monroe Trout, Bruce Bacon, Richard Dennis, John Henry, and did very, very well. So a brokerage firm came along and bought me out. And then I had to figure out what to do, when I grew up. So I just was taking a little time off, and I went to a Cub Scout meeting with my son, and there was a magician performing. I thought I could do that because I used to do magic when I was a kid. So I just started working on it, and I like to combine some of the funny things with it. And it was a stretch for me because I'm naturally, I like challenges. And I decided to go over to the Holy City Zoo and start working on developing an act. That's how a lot of people got started. And I got to be successful at it. I was getting bookings. Margaret Cho and I started together, and we would substitute for each other. And then I started getting bookings all over the country, Canada. So it was a lot of fun. I think I was the only performer to ever be thrown out of the Comedy Store. So it was an interesting experience.
Getting booted out of the Comedy Store, maybe that's a conversation for another day. But I got to tell you, for my 8-year-old birthday, my little girl this year, I booked a guy that did magic and comedy for kids. And I think I had, I don't know, like eight or 10 little girls at my house, and they all left there saying that was the best birthday party I've ever been at. So that's pretty cool.
Yeah. Well, actually, my favorite trick is why I got booted.
Well, then
it involved a mouse and a blender. That's about all.
Okay. And hopefully, no drinks got made out of the blender.
Well, I gave the impression the opposite, but in fact, I came up with that for an SPCA benefit show at the Holy City Zoo, and nobody laughed, so I had to expose the trick. At the Comedy Store, before I could finish, Mitzi Shore who's the owner, yelled from the back in him. These two large gentlemen escorted
Oh my gosh. We were talking before we jumped on about Harvard Business School a little bit, and um, uh, our co-founder of Validea, John Reese, went to Harvard Business School. There was some overlap in terms of the timing you were there. You guys don't know each other, but is I wanted to ask, is that where you first got interested in momentum investing, or was it actually before Harvard? Can you kind of walk us through how you got into momentum investing to begin with?
Well, I started my career with Merrill Lynch before I went to Harvard. And I tried to read everything I could about investing. I wanted to come up with something a little different. So, Lefty Grove said he was successful because he hit them where they ain't. So I was looking for different things to do. And that's when I came across relative strength. Uh, uh, Bob Levy wrote a book about it. And uh, Nick Darvis had something that was rotational type investment strategy. So I was always impressed by that. But I actually focused on stock options and started managing money on the side. I was at Harvard. I didn't have to look for a job after. I just continued money of my classmates, their friends.
I want to ask you, as we sort of work into your dual momentum system, I first want to ask you about momentum in general. One of the challenges we have talking to investors about momentum is investors always want to see some sort of fundamental underpinning for what they're doing, whether it's value or growth or something tied to the fundamentals. And momentum really doesn't have that tie-in. So I'm wondering if you could maybe talk about what you think the best explanation is for why momentum works.
Well, momentum, like all trend type approaches, actually does have that information, but it's reflected in the price. That really reflects all the information that people have. So the reason it works, I think, is behavioral. Uh, you've got a lot of different things going on there. First is anchoring or conservatism. People just don't accept what starts to happen right away. And that's influenced also by the disposition effect. People have a tendency to want to get rid of their winners too soon, hold on to their losers. Well, that also applies when you're getting into positions. You tend to be skeptical when things go up. But what has to happen, though, is price has to catch up at some point, if markets are all efficient. And when that happens, then the other side takes over, which is herding and recency bias. Everybody just wants to and that's what makes it work.
One of the interesting things about your system is that it uses both time series and cross-sectional momentum. I was wondering if maybe you could just define those two terms and then talk about what gave you the idea to combine both of them together into one system.
Well, cross-sectional, that's really not the best term for it. Cross-sectional applies when you take like the stock market and chop it up into deciles, quintiles. So I look at it in terms of assets, different assets looking at relative strength, which is a really old concept. And what I found was after I read all the research on taken place in the 90s, I was impressed, because first of all, when Jagadish and Pittman came with their research, they were just validating what had already been shown by Cowles and Jones in 1997. So that was a big out of sample test to it. And then because efficient market ideas were still prevalent, people wanted to disprove momentum. So they looked at it in all different ways, different assets and different time frame, and it held up, all the way and everything. So I figured, well, there's something there, but maybe it's not being exploited the best way in the marketplace because people have a tendency to just focus on individual stocks. That's what the academic side focuses on in terms of their research, especially. So I took a look and I looked at momentum. This was my first momentum research paper. I compared the results of applying momentum to individual stocks, to styles, to industries, and to geographically diversify stock indices. And I found geographically diversified indices best results. And then a few years later, Geksky and Samanov did a more extensive paper. They took it research all the way back to the year 1800, and they came to the same conclusion. But then I also thought, well, I kind of stumbled upon the absolute momentum idea, which people call that time series, but all momentum is based on time series. I prefer absolute to relative. But absolute momentum, I stumbled upon because I just used some very short-term bonds as alternatives. So what that means is, if the excess return of whatever asset I'm looking at is negative, you just go into short-term bond instead. So that's basically what time series or absolute is. And then I thought, well, let's separate it out, specifically into those two components. And that my next research paper did that. That's where I came up with.
You mentioned that you also looked at momentum on industries. Did that work at all, or was it just that it worked better on indices than on industries, or what did you find in terms of how it worked on industries?
It works on pretty much everything, in fixed income, currencies, industries, whatever. But and in fact, I put industries in my book that was written in 2014 because my data went back to the early 1970s. And then when I got more data all the way back, for another 20 years further, I saw that it didn't work as well with industries as I initially thought. That's why it's really important to have as much data as possible. And still, applying it to diversified geographic stock indices work better than industries or indexes.
One of the points you highlighted in your dual momentum paper was this idea that, if you use momentum on multi-asset strategies, a lot of times you can end up with a bunch of assets that are correlated with each other. And in your paper, you talked about using this module-based approach to address this. And I'm wondering if you could talk maybe a little bit about what you did.
Well, this was in my second paper. And what I did was I said, okay, let me show that momentum is robust, that it works with everything. So I took US and non-US stocks and created a module. And then I took different bond sectors and created a module. And I took REITs and mortgage REITs, another one. And then I had one with gold and long-term treasuries. And I was able to show that momentum works with all of these. But it tends to work the best when you're applying it to stock indices. And I think that's because that really has the best risk premium available that people have been able to validate long.
In terms of absolute momentum, when you look out in the industry, what you see probably most used with absolute momentum is this idea of moving averages. If the asset goes below the 200-day, I sell or something like that. You used a very different approach, in your work in terms of looking at it relative performance relative to a risk-free rate. I wonder if you could talk about what you did and maybe compare and contrast that with more of a moving average-based approach.
I look at a risk-free rate just to get an absolute return, because if you're going to get the same return from T-bills, why bear any risk at all? So you want to use that as a hurdle rate. And then I say, okay, has it gone up or down? It's a rate of change, a certain look back. And that's what absolute is. Now, it's not all that much different from moving averages. You get very similar results, but I found that absolute momentum did give somewhat better results. Valery Zakamulin has a book called Market Timing with Moving Averages, and he has something online people could use called In-Sample Test of Moving Average Trading Rules, and you can go in and compare absolute momentum to simple moving averages, and you can validate that for yourself. Also, there's some software available on the internet, program called Portfolio Visualizer. Parts of it you can use for free and see the same thing.
Yeah, we love Portfolio Visualizer. We've used that in a lot of the different things we've done. For relative momentum, you mentioned relative strength before, which is which is a commonly used approach. A lot of the academic research prefers to use 12-1 momentum to get rid of the most recent month. In terms of relative momentum, what do you think the best measures are?
Well, 12-1 is a little bit misleading in some ways, because when Jagadish and Tipman did it, they skipped the last week, which makes more sense, because stocks tend to be mean reverting over shorter periods of time, days or a week, 2 weeks. But that once you get up to a month and longer, then momentum kicks in, especially over 3 months. So people would skip the last month just because they had monthly data. They didn't have daily. And that really is a phenomenon of stocks, with them being short-term, being reverting. You get into other assets, then even skipping the last week may not make so much sense. So in terms of look-back periods, what time frame you're evaluating over, 12 months is used a lot in the academic side. It tends to give fewer trades, and the results are pretty strong. But Jagadish and Titman showed anywhere from 3 to 12 months, individual stocks is pretty good. And some assets, respond better with shorter look-backs and others with somewhat longer.
We had Corey Hosting on the podcast a while back, and one of the things he talked about is he tries to use a lot of measures, to eliminate the risk that any specific measure will be the one that's wrong at any given time. What do you think about that? Do you think that's necessary, or do you think you can get away with using more specific measures and not have to worry about that?
Well, rather than take a naive kind of shotgun approach, just throw everything, you can have a more nuanced approach. What we do is we have different modules with different look-back periods, and we can suit the asset to the module, because like bonds, for example, respond better with short than stocks do. So I think that makes more sense. Also, look-backs can be conditional on volatility or market environment, things like that. So that's what we use in our proprietary. We try to take it beyond just a naive shotgun approach of throwing everything.
That makes sense. You talked about a little bit about this earlier, but can you talk about, now that we've talked about what absolute momentum is and what relative momentum is, can you talk a little bit about how you bring those two together into dual momentum?
Sure. We apply absolute momentum first. We want to see what the trend is. For example, the simple model I have in my book that anyone can apply, we look at whether the S&P 500 has gone up or down over the past year. And if it's gone down, then we move to the safety of intermediate term bonds. And if it's gone up, then we know we have positive absolute momentum. So then we compare the performance over the past year of U.S. stocks to non-U.S. stocks. We go with whichever of those two has been stronger. And we hold it until there's a change.
Have you been able to look at if you just used the relative momentum system versus adding in the absolute momentum on top, like what do the risk and return characteristics look like, comparing those two different approaches?
Well, that's very interesting. And in fact, when I give a presentation, I show the relative momentum part first, which is just switching between U.S. and non-U.S. stocks, depending on which has been stronger over the past 12 months. And there's actually an increase in return with that strategy of almost 200 basis points.
Wow. Just
doing that. And how many money managers do you know who would be delighted to show, 200 pips in extra return every year doing something this simple? And you're always fully invested. There's very little tracking error. I've always wondered why institutional money managers who have a mission of always being fully invested aren't doing something. And the only thing I could think of is, home country bias, which is very strong throughout the world. They don't want to be 100% outside of the U.S. market. Now, when you take and you overlay absolute momentum, you can get twice the increase in return. So instead of 200 bips over the long run, back testing has shown back to 50 that we're looking at about 400 bips by doing both together. In addition, you drop the maximum drawdowns to less than half what you would get for this being.
Interesting. Yeah, and one of the reasons a lot of money managers probably don't use it is because it's they want to act like they're adding value, and it's not something that's it's something that's so simple that they probably want to show to their clients that they have some sort of more complicated system they can run, despite the better returns of it.
That's very true. There is a bias against simplicity, which is ironic because usually simpler is.
We use some absolute momentum systems ourselves, and I wanted to ask you about one of the challenges we face to see what you think about it. One of the challenges we've faced in running money is, I don't know if you've heard Jim O'Shaughnessy talk about this, but he talks about the 2 points of failure for investors. And one point of failure is when the market's down, investors will sell at the wrong time. The other point of failure is when they're underperforming the market, they'll sell at the wrong time. And
Yes.
that's the big challenge we've had with our trend following systems is, a lot of times we think the second point of failure can be worse than the first. If you're doing worse than your neighbor, in a lot of ways, that's worse than losing money. And so I'm wondering, have you found that as well? And do you think there's anything that could be done maybe to address that?
Absolutely. I think you're right that the second one is certainly more prevalent than the first. And Greg Fisher once said, we don't have people with investment problems. We have investments with people problems. I think that's very true. So the only solution I found is to try to keep educating people because, they tend to forget. They tend to get very myopic and just look at what's going on recently, and they don't keep the big picture in mind. So I discourage people from looking at performance too much, and I encourage them to study the research and try to keep the principles in mind. And the fact that if something has worked over 50 years, or in the case of momentum, 100 or 200 years, or even longer, that you got to give that the benefit of the doubt. The worst thing
Go ahead.
people do is switch from thing to thing, and that happens a lot. Even in the pension world, you have pension fund consultants typically look at the last 3 years of performance and make suggestions, and clients would be better off not following those suggestions.
It's funny to that point, you're probably familiar with the permanent portfolio mutual fund, and the permanent portfolio mutual fund, which uses gold, bonds, and stocks, it always has the most massive inflows basically at the bottom. So once the market is basically completely collapsed, everybody is de-risking and going into it. And now, when we have a big market run, everybody's taking their assets out of it. So it goes to your point that, people are always abandoning these systems at the wrong time and going into the other systems at the wrong time.
Correct.
I wanted to ask you, and in reading one of your papers, one of the interesting things I found is had actually applied momentum to fixed income, which is not something you see done too often. I was wondering if you could talk a little bit about how you did that and maybe what types of assets you had in the mix that you were evaluating from that perspective.
Yes, momentum works really well with fixed income. You just have to modify your look for it, because bonds tend to move in a different way than stocks do. So what we do is I have two main dual momentum models, and what they do is when we're out of the stock market, we'll look at different intermediate and shorter term sectors of the bond market, everything from T-bills and TIPS, 7 to 10-year treasuries, and we'll use relative strength to determine where we want to be. I also have a dedicated fixed income model, and that adds high yield bonds. We don't need high yield bonds in our other ones because we have equities, so we capture the equity that way. But if we have a standalone bond model, that high yield bonds.
And how have you found, in terms of rebalancing periods for absolute and relative momentum when you run your strategies, how do you think about that? I mean, obviously, some people want to rebalance monthly just to, always have the best momentum in their portfolio, but you have the issue of turnover and transaction costs, and then others maybe use longer periods. So what have you found works best in terms of rebalancing periods?
For two of the three models, I use monthly. And then I have another one where I'm able to actually utilize daily data. And I found that rebalancing, it's a proprietary model. I can't details, but it rebalances a little more frequently.
You've done some research and testing around what time of the month it might be best to rebalance. What have you uncovered there? Is there a better time, or could it be the end of the month, or what's your research show?
The end of the month, first couple of days of the next month, those tend to be the best times for rebalancing momentum. The reason being that institutions are evening up their portfolios at that time, so you get fairer prices. But I'm just basing that on the data. You know, we've gone through and we looked day by day, what's the best time. So, sometimes with some models, you know, the model itself dominates the time. So I have one model that uses market structure, and it'll make a change on whenever that happens. It doesn't have to wait until the month.
Is there in the main model, is there a main drop off in performance when you go from monthly to something like maybe quarterly?
Yes, from what I recall, there
Mhm.
is. I've looked at quarterly, I looked at bi-monthly, monthly, weekly, all different time frames. And the, you have to reach a balance. If you rebalance too frequently, you know, you'll just get whipsawed, allow the markets to. And if you wait too long, then you're just not sensitive to what's going on.
Yeah, that's sort of one of the criticisms with momentum strategies is, a lot of the excess performance can be eaten up by transaction costs or indirect costs or slippage or, things that happen when you trade a lot. Um, I guess with indexes, you're trading things that are very, very liquid. So you're probably avoiding any of that. But what do you think about this criticism of momentum strategies not working after transactions are taken into account?
Well, that has to apply. That applies to stocks, individual stocks, because they tend to be momentum stocks tend to be very volatile, and they have wider bid-ask spreads, and there's also really high turnover. So that's a problem. My academic paper, there've been a number showing that that can be an issue. But when you're dealing with indices, it's not a problem. They don't have the same wide bid-ask spreads. So usually don't have the same kind of turn. On a stock portfolio, you might turn over 25, 30% of it every time.
Have you ever tested or looked at incorporating other asset classes, things like commodities, gold, other asset classes that might not be necessarily correlated with equities? Have you done any research around that?
Oh, sir. And in fact, in both of our momentum models, our proprietary models, we use commodities. One of them uses gold. In fact, that's pretty much what they're in right now is commodities, gold, tips, and cash.
Yeah, yeah. We run a few strategies based on research papers, protective asset allocation and generalized protective momentum. Are you familiar with those?
Yes.
So similar type of, our models are sort of have been de-risking too and moving into those areas. So, and that's one thing I want to ask you about a few minutes here, a little bit more on that. But one of the other sort of sticking with this momentum theme, one thing we've seen in the market when we think back, maybe, I mean, not it's post financial crisis, but 2015, 2018, 2020. And we'll see about the period we're in now, but those other three periods in the market. So 2015, 2018, 2020, we saw pretty large declines and then, very quick bounces, once the market bottomed. So they're sort of sharper declines, they seem like, and they seem to have followed by quicker recoveries. And maybe that's because we weren't necessarily, really going into a true bear market in those periods for a host of reasons we could probably discuss. But I'm just wondering, when you sort of think about what's been happening in the market, do you think that sort of should change the look back period that's being utilized in some of these momentum strategies in any way?
Yes, absolutely. We That's why we switched to a module approach in our largest momentum model, so that we could use different look back periods. and have a balance of them. Uh, and a year or so ago, there was a paper out called Breaking Bad Trends, something like that. A Cam Harvey and his people put out, which they showed the same thing. The markets tend to change more now. They tend to have more swings going on, and so you're better off having different look-back periods, shorter and longer ones. Another way to do that is to make your look-back conditional on market, what the markets are. That's something I've done for quite a while.
I just wanted to get your thoughts on the idea of using momentum and combining it with value or quality. Now, this wouldn't necessarily, because you're using indexes, it doesn't, well, you could get a value index or a quality index. There are indexes that exist that hold stocks with those types of characteristics, but this is, I guess, more so on the stock selection side, the people that are combining momentum and value, let's say. But do you have any thoughts or opinions on whether combining momentum with something that's uncorrelated to it can help improve a strategy's risk-adjusted returns when combined together?
I've tried using those different areas within the momentum framework, and I haven't found quality or value to add anything. I found some other factors that are part of proprietary models that have been useful. And like I say, it can be good to have alternative approaches. One of my models, as I mentioned, uses market structure in addition to momentum. So that has value. But as far as using things like value and quality, that really helps.
Can you just shake out what you mean by using market structure when you're explaining that and how that actually works?
Well, it's based on price action. How prices, reach certain levels where they are expected to indicate a change in trend. And that doesn't depend on time, it depends on price. So that's what I mean, price action and market structure.
Right. Okay. I wanted to, given the declines we've seen so far this year, and you've already kind of hinted towards this, your proprietary model has kind of de-risked and moved into some of these asset classes that are uncorrelated with equities. But are we getting now close to being negative on like the absolute with the US market? Because I'm thinking like last year, the returns were pretty much all front loaded. They were all at the beginning of the year. So since like, maybe April of last year, the market hasn't really done too much. And now we're down 10% for the year, maybe a little bit less than that after today. So at some point here, pretty soon, we're going to be below the risk-free rate, and that would basically be a sell. And maybe we're already there. I don't know. I'm asking, how close are we to that sort of negative return on US markets, given the way that you look at looking at these indexes through your momentum strategy?
Depends on your look back period. If you're using a 6-month look back period, would have gotten out
Right.
recently. If you're looking at 12-month, you may have to go through a lot more downside before you're able to get out. That's why, we've made our models more adaptive.
As we get into sort of the last few questions here, I just wanted to ask you this question on US versus international markets, because you've had this vantage point of looking at all this market data over a very long period of time. And obviously throughout stock market history, you have periods when US has done much better than international. That's pretty much been like since the financial crisis, probably US has done a lot better than non-US stocks. And then, from 2000 to 06, international was maybe even further than that, 2000 to 09, international was more so the place to be pre-great financial crisis. So I'm wondering, because you have that and you've looked at so much of this historical data, what are your thoughts on, and I'm kind of asking you to make a prediction here, which I personally don't love predictions, but I'm just more interested in your perspective on, do you think that, international stocks are set to outperform US stocks given the massive outperformance we've seen in the US versus international?
Well, I'll have to get up my crystal ball here.
Okay.
Yeah, you never know when you might need it. So I have no
Oh,
idea. I
nice.
just
Me
follow
too.
market action, see what the market has to say. People can make that case based on valuation. You can say, well, value looks pretty good, or looks good based compared to the U.S. on a valuation basis, but that's not such a good way to time what you do. It just means over the next 10 years, you might be looking at lower or higher returns. So I just follow the markets. I don't try to predict what's going to.
Yep, love that. Stick to your discipline and core competency. Um, I wanted to switch gears and ask you about this paper you wrote on trend following with Bitcoin, and sort of what your findings were in that paper, and talk a little bit about applying trend following to a higher volatility asset like Bitcoin.
Well, I started doing that in 2017. I took a dual momentum approach, looked at a whole bunch of cryptocurrencies, absolute and relative. I did pretty well that year, but I think anybody in crypto. And then was a side after that because the trends were going down. And then I just decided, when Bitcoin got so cheap, that I just buy some and hold it, went up eightfolds. That changed my mind on what, I have to manage that. So that's when I took a look at creating a simpler trend following model. And the key to that is instead of looking at monthly or weekly, even weekly, you have to look at daily, because Bitcoin was so volatile. So basically, I just took a simple trend following approach that's worked, since the 1950s or earlier, and works on lots of different markets. That's something I always look for, is longevity on something that, nothing that you just come up with and fit the day. Something that's been proven to work successful over long periods of time. And that's what I apply to Bitcoin.
What was the result of that in terms of the performance versus just holding the asset? I'm guessing the losses would have been much less.
Much less. I think the max drawdown on a ending trade basis for Ethereum was 25%. It's been 16%. Over 80% winning trades. Ethereum's had the same CAGR as buy and hold. Bitcoin's been 70%. So the backtest results, so last year and a half has been out of sample stuff.
And in addition to using daily data, did you also have to speed up the signals with Bitcoin? So, I mean, I would assume something like trying to wait for breaks of the 200-day moving average or something probably wouldn't work with Bitcoin because it moves so fast.
Yeah.
Did you have to speed up your signals as well?
Yes, yeah.
Okay.
But there are ways not to have a lot of trades. I look for confirmation with those two markets, similar to Dow theory, where I want to see them both go in the same direction.
Just this last one question that popped in my head before we get to the standard closing question, but what do you think of this idea on asymmetric, like, timing signals? So, like, for example, maybe the sell is you close below the 200-day, but you're buying if you close above the 50-day. I'm thinking, like, to try to help against, like, whipsawing, and so you're giving yourself more sort of to the downside, because I'm just thinking of the US market, most corrections don't turn into bear markets. So if you sold to every single correction, you'd be kind of in trouble from a performance standpoint. But you want to make sure that you're selling before obviously the very worst of the bear market. But then, at the bottom of the bear market, you want to be in pretty quickly because that's where some of the, best returns can come from. So I'm just curious if you could comment on that, the idea of something like that.
Well, it sounds good in theory, but the problem is in implementation, because let's say you get out, you switch your time period. What do you do? Locked in for a longer time? It may not make a lot of sense logically to do that. So what I think makes more sense is just to identify what market regime that you adapt a look-back period that's suitable.
Okay. Yep, that makes sense. Okay, so for the standard closing question, we want to ask you, based on your experience and the research that you've done, if you could impart one piece of wisdom or teach one lesson to your average investor, what would that be?
That would be kind of along the lines of, I heard this from someone describing a philosophy of life, in terms of their life's journey. And that would be investigate carefully, choose wisely, and follow faithfully. So I'd say the same thing applies to investing. Do your homework, do as much research as you can to satisfy yourself that what you have makes sense, that it's something that you can stick with and not lose confidence in. Go with it. Don't be shy. I come across people all the time who say, well, I just want to stick my toe in the water, see how it does for 6 months. And that's not the right attitude. Anything could happen, 6 months or a year, 2 years, whatever. What you need to do is do your homework, do the research. Be sure that what you have makes a lot of sense, then commit to it and then stick with it until you have some good reason for changing.
Great. If people want to learn more about you, the research you're working on, follow you on Twitter, where can they go? What's your Twitter handle?
The Twitter handle is just my name. I have a website called optimalmomentum.com. There's a link to my blog. And then I have a book that explains the basics of an approach at dual momentum investing. It's one of the best-selling investment books.
We'll put a link to all that stuff in the show notes. This has been great. Gary, thank you very much for joining us. We appreciate it. And hope to have you back on maybe in the future to talk more momentum. Take care.
Thanks a lot, Justin.
Hey guys, this is Justin. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant, and you can follow me on Twitter at JJ Carbonneau. If you found this discussion interesting, please like us on iTunes. Thanks again and see you next time.